Hello everyone, I'm Steve Savant, host of the Business Insurance Zone. Today and all this week, we're talking about tax-free income using life insurance, part of our series on tax-advantaged income. A Non MEC life insurance contract can generate tax-free income via withdrawals to basis and policy loans of gain as long as the contract is kept in force for the life of the insured. And with me today to unbundle the withdrawals and policy loans is my special guest, Eric Palmer, National Director of Advanced Sales here at Brokers Alliance. And Eric and I are going to walk you through the little-known tax item called the force-out rule, the great E&O exposure issue of tax-free distributions using life insurance. Better pay up your E&O. Yeah. And remember, before moving forward with anything we talk about on the show, always check in and get counsel from your CPA, your attorney, and if you're FINRA licensed, with your broker-dealer compliance departments. Well, welcome everyone. I'm Steve Savant, the whiz of the biz, and with me today is Eric Palmer, National Director of Advanced Sales here at Brokers Alliance. Welcome to the show, Eric.
Glad to be here.
The Business Insurance Zone is a Bravo broadcast initiative of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, distributed in wonderful HD 1080p all over the internet on YouTube, Vimeo, Facebook, Twitter, and LinkedIn, and of course our on-demand video section on brokersalliance.com. The show's email address where you can write us is thebiz@brokersalliance.com, or you could call us toll-free, 1-800-290-7226, extension 147, for any of your quotes or questions you may have on life insurance, annuities, disability, long-term care, and group pension. And remember, heads up, we're broadcasting and recording this shows in November, which is LTC Awareness Month. So if you're not talking about it, you should. It's all over the internet. I've been blogging and tweeting on it for a long time. Well, all this week we've been talking about this. What is it? Tax-free.
Right.
Investing with life insurance. And I want to bring up today, we talked about distributions yesterday. We went all geek on you on how to make illustrations work. Today, I need to talk about loan provisions. Now, before we get into the loans, I need to talk about the force-out rule.
Right.
Now, the Technical Corrections Act in 1987 made a kind of a small, I would use the word, fine adjustment on the rules of engagement on withdrawals to basis. Even though the annuities and everybody in the industry on the annuity side already had switched from FIFO to LIFO,
right,
we were still getting some kind of good FIFO treatment on this, and that was a really good thing. But the Technical Corrections Act came back and said, and listen to this carefully, and remember, there's a whole section of law on this, and if you need to see it, we're happy to punch it out to you. The force-out rule manages the first 15 years of any life insurance contract after 6/21/1988. So mostly everything's been written now. It's going to be after that.
Right.
Any withdrawals to basis during the first 15 years of a contract where there's gain involved could expose it to tax. And usually I would say withdrawals to basis, it's basis.
Right.
There's no tax here.
Right.
But that little bit of Technical Corrections Act actually kind of modified the language. And so if we're taking withdrawals to basis, which I normally would love to do, during the first 15 years of any contract, it could expose your client to a taxable event if there's gain in the contract. This is a little known idea.
No, it's a huge issue because I don't think the average insurance advisor out there that's selling lifetime income scenarios out of life insurance is even taking that into consideration. There's been a feature that's added to a lot of software platforms out there that it's an optimal switch. It provides that sort of predetermination of when it's okay to switch over from basis to loans. And if you're just assuming that it's always correct, you could be putting yourself in a position to create a taxable event for your client because that optimal switch according to the software might be under the 15-year mark.
Yeah, hopefully they've taken into account everybody that is a carrier purveyor who pushes out their software has taken this into account, hopefully. Now, the reason we just bring it up is just because I want to get rid of basis so we can talk about loans for the rest of the show because there's so much to talk about here.
Right.
And I want to make sure we're all up to speed on what's going on so that you're fully aware of what you're sharing with your client. Now, when I talk about withdrawals to basis, generally when I'm involved, I do my customization. Whatever the computer says on most of these software packages, we think our customization is actually tweaking it better. I generally don't take withdrawals to basis until I'm past the 15th year for that, not only the force-out rule, because I'm not really sure what the actual gain in the contract's going to be.
Right.
Now, let's go back to that issue just for a second. Because I don't know, I can only project whatever. And remember, most of these illustrations that we see coming in here are fantasy.
Right.
I mean, complete vapor on paper.
Right.
So when I'm looking at these contracts, I have to assume I don't know what that return's going to be. What if it goes through the roof? I could have a problem with a taxable event. I'm just going to take withdrawals to basis after the 15th year. And so if I need to take any income before that, it's going to be a policy.
It's going to be a loan.
Okay.
Right.
Now, Eric, let's talk about this because I love the aspect that tax-free life insurance has. Access to policy loans free, as long as we keep the contract in force for the life of the client. Now remember, if the contract doesn't extend that far, then you need to get a contract that does.
Right.
We're not going to say, if you're doing income and I see you get a contract that doesn't extend it, I'm going to say, whoa, stop. Why are you using this carrier?
Right.
Okay. Number two, the other thing about it is when I'm looking at policy loans, there is 5 different ways of taking money out on a loan. Now, until I really saw this, I didn't understand the impact it could have on distribution. Talk a little about in the generic first, and then we'll get into specifics. Policy loans, because I do want to take them out because it's a really good deal.
Right. Well, first and foremost, I think it's important to note that not every carrier provides all of the options that we're going to outline today. Right. All 5. So when you're selling, life insurance for the intent of having your client take a supplemental income out, there's going to be a loan conversation that goes down. The first thing you want to do is identify the carriers that give more than one option, because the different types of loans that are out there, they're either fixed or they carry some level of spread over a fixed rate, like a Moody's rate, and it's basically the money the insurance company is going to hang on to. That falls off after a certain period of time. There's a lot of moving parts there. And depending on the environment that you're in when you go to take a loan, it's no different than going and taking a loan from a bank, right? What's the interest rate like right now? Well, we're at a historical low interest rate environment, so you're going to want to be borrowing at sort of a prime or LIBOR-based loan rate right now. But in a world where the markets are flourishing and bank rates are naturally kind of high, you might want to look at some form of arbitrage loan or something else. And the same sort of principle applies to the life insurance. Is you want options because in 15 years from now, when your client goes to take income, a fixed loan, things could change, or a variable loan might not make sense at that time.
I actually wrote an article for the CPA Society called The Recharacterization of Policy Loans. It's an article. If you want it, I'm happy to give it to you. I think it's out on one of our pages.
It is, right.
Which one?
Our tax advantage products.
Perfect. www.brokersalliance.com/tax advantage products.
Right.
What I do is I review some of the things we're going to talk about here, and this is in the newsletter of the CPA because they're just now getting into this. I had a contract. How I wrote this article was I was under a consulting contract to review several policies through a CPA firm which didn't understand our side of the business, and I looked at that and I noticed that forgiven loans on a policy are recharacterized as ordinary income. And that was an issue. And every time we saw that, I was looking at these contracts thinking, oh my goodness, there's going to be some taxable events here because of the way this has been constructed.
Right.
Constructing it, as we talked about yesterday, is very important. That's why I bring it up. Now, when we talk about it, let's talk about the first one because this is the one I actually love the most. If you have to use it, it's called zero net cost loans, zero net. Now, that means that I'm charging and crediting the same rate. But now the word is, why is it zero net? Because of the time that it's charged and credited. The shorter the period, the better I like it. Now, heads up, the service has looked into some of this in the past. I don't know if it's gotten off the table or not. Is it a legit loan if I'm crediting and charging within a 60-day, 90-day window? There's an issue here.
Right.
But right now, there are certain carriers that we really like that are doing zero net cost loans in the contract. And by the way, a couple carriers only that actually guarantee it in their contract. It's not just current company assumption. It's actually in the policy as a contractual provision.
Right. It's actually not very common anymore.
No.
It's exactly what you said, though. It's a short period of time. It makes those numbers wash, sense the cost in a sense, one another out. And so you're actually not taking in a negative, if you will. We talked a lot about the interest crediting and the costs and controlling the costs inside the contract. Those types of loan give you a little bit more control over that factor because some of the other loans we'll talk about here in a minute could add more cost to the equation, making it ever more dependent on the rate of return in the policy itself. So the zero net cost loans, I think, kind of take a less dependency on the rate of return on the policy itself because it's zero in itself.
I love zero net cost loans, and as long as we can use it, I'm using it.
Right.
And like I said, a few carriers actually put it in their contract, so it's not just current company practice. Contractually, it's an imperative. And one or two companies actually allow you to access it day one. Now, there's several carriers that will use zero net cost loans, and they'll let you access it 5 years, 10 years down the road.
Right.
Because there's preferred loans, there's standard loans, they're all this. But a couple carriers actually let you take constructive receipt of it day one if you could do it. You could do it. So it's a positive. It's that space and time that really makes zero net cost withdrawals. The shorter the period, now when you expand it to a calendar year, that's when you have a difference.
Right.
If I have a same charging and crediting of the same number, let's say 2%, 3%, whatever it would be, and I'm charging and crediting at 365 days apart, that's really what we call a wash loan. It washes its calendar year, day 1, 365. However, when I start to take out loans on a wash loan over a long period of time, because of the differentiation, the difference in time when I'm crediting and charging it, there could be an additional charge. It's minuscule, but still an additional accrual charge on a wash loan. So when I say it doesn't cost my client, I just want to know, heads up, heads up. It might have a small accrual charge because why? The charging and crediting is taking place 2 different time periods at the beginning and at the end of the year. So I just want to be heads up, be open when I say a wash loan, and there might be, and it could be as small as 15 basis points. Right. But I want to just bring it up.
Well, and it could play in with the time in which your client actually takes the withdrawal. So, it's always going to have a lag feature because you're crediting the rate before you're actually taking the rate off. And then if you, at the end of the year, are applying the rate and then you're recrediting the next year's rate a day later because you're on calendar year, then you're always going to be a step behind and truly washing out that loan. So if you're halfway through the year and you start taking the loans to your contract, then you've got X amount of period of time that the cash value wasn't performing. Therefore, what's going to be credited the day after the loan washes is going to in fact be less than what you've taken it out. So you're actually losing in some situations based on when you're actually taking the income or taking the loan from the cash value.
And generally, I have to say, heads up, current company practice on illustrations and proposals, I have not seen the accrual charge put inside that. And the only way I can do it is to make sure when I call for my in-force ledger, if I have one, I have to bring it up. I have to bring it up because I don't think it's going to be published. I have to actually tell the company, hey, I need to see the all-in, and if there's any accrual charge, please make sure that it's reflected inside the values. Well, remember, you can download and view this entire series we've been doing all this week on tax-free income using life insurance. And you can go out to our website, www.maxretirementreport.com, as well as our Tax Advantage series we recorded about a month ago, and get that information. That's huge. www.brokersalliance.com/tax advantage products. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. When we come back, Eric and I are going to start pounding on direct recognition loans, spread loans, and arbitrage loans. I'm just taking a moment between our segments. If you're looking for new ways to expand your practice, I know of no other good way except for tax advantage strategies, and it could be a game changer for your business. With everyone projected to live longer and taxes expected to increase, tax-advantaged income strategies for retirement will become the most important component for savers and investors. At Brokers Alliance, we've designed tax-advantaged income strategies using annuities and life insurance. From annuity income riders to medically underwritten SPIAs, from participating whole life to current assumption or indexed UL, we have the concepts consumers are looking for. These are tax-advantaged income strategies, and they can generate more net spendable cash in your clients' pockets than conventional concepts currently being used by professional planners. So you can view and download the white paper on our loans and the tax-free video series at www.maxretirementreport.com, as well as our tax advantage video series we did a month ago, www.brokersalliance.com/tax advantage products. Back to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and interviewer extraordinaire. And of course, with me is Eric Palmer, our National Director of Advanced Sales, and we're talking about tax-free income off insurance, life insurance. I can't believe it. Second segment, we're continuing our saga today on policy loans. Now, before I go on, I want to read our caveat just to make sure that we're covering our back door. Remember that everything we're talking about in tax-free is proviso on this statement. Life insurance policy must be designed as a non-modified endowment contract. The contract has to be kept in force for the life of the insured. If the maturity date of the contract does not contain a maturity date extension provision, the client should be notified in writing in the application and have him initialize it. During distributions, any withdrawals of basis or policy loans of gain must comply with the force-out rule, the guideline annual, and the guideline single, and the CVAT, or Cash Value Accumulation test. Now, we always try to comply with that, and if you send any of the illustrations you want us to do, any of your proposals, we already do that. Now, we talked about, in the first segment, zero net cost loans, spread loans. Now we're talking about, we talked about zero net cost loans, wash loans. Now we're talking about spread loans. Spread loans is the charging and crediting of the same rate, 365 days apart, heads up again, whatever the rate is, let's say 2% in this regard or 3%, there's also an accrual charge to that because the charge and crediting is happening at two different times.
Right.
Okay. And the spread loan, now remember, we talk about consumers, when I think, oh, well, so it cost me with the accrual charge 235 basis points, 2.3%. It sounds low. Now, for maybe a mortgage, maybe a car loan, maybe your credit card, I wish, right? But when you think about it, it's really, that is a high-end loan. And we haven't even got to some of the other ones that could be much more expensive.
Right.
So when I'm looking at spread loans, that's one thing. Now, Eric, the real bad boy issue, I think, is, and there's not that many carriers that do it, but they still do it. They call it direct recognition spread loans.
Right. Well, think about, the spread loan in a sense is already adding an additional charge to what the borrowing rate is, because the insurance company more or less wants to protect themselves, especially against early withdrawals. So a lot of times you see a spread loan last maybe 7 to 10 years in the contract, and then the spread would drop off and you'd be borrowing at sort of a normal rate. So that spread is already adding 75, maybe a whole point of cost to the loan itself. Then you get into the direct recognition spread loans, which you find with whole life insurance, and there again, you're not only just getting that having that spread added in addition to the overall cost, but now you have the potential dividend effect, the actual reduction of the dividend based on how much money
to the cash value.
Right. So now you're just adding more and more costs to the structure here. And again, remember, at the end of the day, if you're going to continue to take loans because you're doing this for supplemental income, you want to count on it year after year. And if we're adding all these additional costs to the equation and we're not getting the rate of return back from the policy, the question becomes, will this be here next year for me to take another loan? Will a policy lapse? Is it going to hang on there? Because especially when we talk about variables and index, it could be zero and it could be a negative return. You could be just adding cost to the contract and not adding any additional return.
There's not that many carriers that still do it, but the problem is that the ones that still do it are big names.
Right.
So that's why we have to bring it up. It was a small carrier, it wasn't really happening. But direct recognition loans is a very expensive way to tap your own money out of your own contract.
Right.
So it's a provision, a policy loan provision that I have to say, I think is an issue, and so just be aware that there are certain carriers that still do this. Now, a lot of the par whole life contracts, I'm thinking like Mass Mutual is the first one that comes off the top of my head. They don't do that anymore, and so they use regular spread loans, which I'd love to see them do even lower to zero net cost or wash, but at least they're not doing direct recognition loans.
At least it's somewhat of an improvement, because if you start taking away that dividend rate, again, it's just every 10 basis points that you take out of the equation is less cash, less income at the end of the day for the client.
Yeah, just remember, as I said before in previous episodes, Einstein's theory of relativity is one thing, but his thing that he was in love with was compounded interest over time. That's compounded interest accumulation, or the reverse. Oh, I'm taking away from it.
Right.
See, so that's an issue. Now, what we want to talk about with our remaining time in our segment, arbitrage loans, exclusive to indexing. Now, some index carriers actually use the word participating. I don't like that because it mixes the words or the metaphor that we used to use with whole life. So today, for our show, for our purposes, for distinction, it's arbitrage. Talk a little bit about this, because this is wild. We have variable, we have fixed rates.
Right.
We have contractual imperatives and what the current company assumption is. And I mean, it's all over the board.
Well, the main thing that you start to look at for arbitrage loans is key in on that word arbitrage is the playoff of the rate of return in the policy versus the rate that you're going to borrow the money at. And so the idea with an arbitrage loan is that the policy is going to do better than the amount of money that you're taking back. That's the goal. That's what we want to achieve. We want to get more return out of the policy, even though we borrowed some money. It's also a process by which a lot of times the carrier is including the sum borrowed in the total sum that the next year's interest is being accredited to. So even though you took $10,000 of cash value out of the equation, it could still be included in the block in the segment of the index, for example, and possibly be arbitraging against the rate of return in the index itself, therefore providing above and beyond what you borrowed, you actually still make some money in the contract.
So if I have a 5% loan and I made 8% with the index, I take my loan out at 5%, but now I'm making an additional 3% off the money I loaned to myself on my own bank.
Exactly right. And that's why it's really competitive against some of those alternatives out there or different types of investments. But the biggest difference there or differentiator is the fixed versus the variable. Right now, the popularity seems to be pushed towards variable loans. It's used in a lot of illustrations that we come across. And quite often, it's the only option that a carrier offers in the index world, which I view as somewhat of a limitation.
It is.
I think that, it's hard enough for us to predict what the rate of return of the policy is going to be, especially on the IULs or the VUL chassis. But knowing in 15 years from now whether a fixed rate or a variable rate is going to be better for my client is completely unheard of. You can't predict that stuff. So if your client has the option of choosing a fixed or a variable loan, I think they're a little bit better positioned because they have the ability to determine at the point in time that they're taking the money what's most appropriate for them. A variable loan can leave you exposed to a very high rate of return.
Really high.
If we have inflation,
Right.
It could very well be a 10% loan. Well, inflation has no effect on a current assumption rate if the policy is capped off at a certain number. So if we're basing our rate of return on the policy off of an index like an S&P, you could still be averaging 2% a year, but your variable rate could be off the charts. And so in that situation, the policy could lapse, the coverage could go away, we could cause a tax event on the outstanding
huge.
loans. Right. I mean, lots of things can go wrong there because your client only had a variable rate option.
Yeah, so we want to be able to really, heads up, as Eric just said so eloquently, I want to make sure I can pivot. I want to make sure I can make an audible call during distribution. Now, if I guess I was up against this and I didn't know if I want to do a variable loan, fixed loan, or I had the choice but I didn't know what to do, I can always punt under arbitrage loans and actually do the unthinkable, withdraw to basis. I mean, at least it cost me nothing for 1 year. Maybe that's a good way to get around that.
Right.
But I want to make sure that we understand, is it current company practice? Is it contractually guaranteed? Do they give both provisions? Are they giving fixed and variable? And every once in a while, as I've done this before, Eric knows this, I'll test a distribution using the 2001, 2, and 3 years where we actually had negative S&P. Then I showed the client, look what happened here. I still had to pay 125 basis points in expenses, and I had to pay 500 basis points to take the money out of my own contract. That was the loan provision.
Right.
So now I'm in for 600 plus, and that happened 3 straight years in a row.
Right.
So that's compounded loss to take my own money out.
And I think it's clear, the last 5 days now we've been talking about all these moving parts to supplemental income planning, and I think that we've established a very clear principle. It's not as easy as it is to run the illustration itself. The idea that you can sell supplemental income is great, but it is somewhat complicated in terms of doing it right, following the right steps, putting the right procedures in place, using the right products. That's where Brokers Alliance it really lends a hand to our advisors out there, because we're not discounting the fact that it's the #1 growing market in the insurance industry. Supplemental income is here to stay. It has the largest audience. You need to be in this space if you're going to survive in this industry. You just got to do it right.
Right. I want to really just encourage all of our producers. We really have went out of our way, and if you've watched all 5 of these shows this week, you'll understand why we are really due diligence on this matter, because we really want our clients to do well. We want to close the mouths of our detractors.
Right.
People who say, oh, life insurance is too expensive, it's a ripoff, it's this, that, and the other. If it's done right, it can be huge. The tax advantages are great, and if you manage the expenses, they can be low, and if you have flexibility with the contract on policy loans, especially in the good years, oh my goodness, arbitrage loans could be huge.
And don't get comfortable with just one product or loan regime either. I mean, everybody is different. We like to run 3 or 4, if not even 5 examples per client. And it could be a difference of 1 year in age, but it could be male-female difference. Right. It could be a health impairment versus a preferred non-tobacco, or it could be someone's in New York and we have product limitations there. So, there's all these variables to come into consideration. We've done all the homework already, so we save the time and the effort that needs to be spent by an advisor. Just bring us your case and we'll start doing the homework on it.
And we're going to test this for you. So in other words, if we're going to recommend arbitrage loans, we'll show you how it works, why it can work. And I love it because it is actually, if it's done right and you have the ability to pivot away from it in case we have a bad boy year, it can be huge for the client. And I want to be able to tell the client, hey, we're loaning you your own money, and you're making money on your own policy.
And this applies both for business and individuals. You know, we mentioned business briefly in the middle of the week because there can be some taxable events created inside of a business with the death benefit and so on and so forth. But that also too can be done correctly, and that also typically puts us into a shorter window of funding and a shorter window of needing to take loans, which means we're using a different type of loan regime and a different product. So, you know, knowing where to start is the biggest thing. You know, and I think we can help our advisors, you know, get started in the right direction.
If you don't know the loan provision that you're doing or selling or the illustration, just remember, send it in. We'll look at it in Ports Ledger. You can always call us. We're happy to do a complete review, especially in these income scenarios, because they're so complicated sometimes, and the mechanics, the mortality mechanics, are just really all over the place. And we'll show you whether it's zero net cost loans, spread loans, wash loans, direct recognition loans, or arbitrage loans. We'll be able to tell you, hey, this is what's going on in your policy. And then if you can, anytime you're collecting information, I'd love to see the actual contract, the actual policy, because then I can really tell you exactly what you can and cannot do.
And things have really opened up in the last 3-4 years. You know, Index Universal Life has become popular in the last few years. There's a lot of contracts that have been written. So if you're also looking for opportunities to open your own marketing potential and untap new prospects and clients, go find the individuals that bought IULs 3, 4, 5 years ago, or maybe they had purchased some of the old Indiana Life type contracts out there that might not have had some of the additional loan provisions that are available today. It's a great chance to do a life insurance review, make sure the policy was designed correctly.
Well, Eric, I think this whole week what we've tried to do is set the bar for high use, good use of life insurance as a supplemental income product. I totally recommend it. That's how you're going to save your practice if you're going to play in our space. Remember, you can watch this video and get our white paper out on our site, www.maxretirementreport.com. You can also go out and get our 5 video series that recorded a month ago on our Tax Advantage series, www.brokersalliance.com/tax advantage products. I'm Steve Savant. You've been listening to the Business Insurance Zone. Well, that's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse and Brokers Alliance, one of the largest distributors of insurance services to a nationwide network of insurance professionals. You can contact Brokers Alliance at brokersalliance.com or 1-800-290-7226, extension 147.